Hello and welcome to Acumen Analysis, the show where we talk about economics, market conditions and politics and how that impacts you and your business.
Welcome to Acumen Analysis, where today we're talking about debt and all the terminology in debt, and hopefully that's going to be helpful for you and your business. So, you had a background in working for structured finance department in EY. Give us a bit more of what that meant and who you were helping and what you were doing.
Well, my clients were looking to borrow money in order to fund projects. And the question was always, how do we get as much money for as little as we can? So we had to structure that debt, hence there was a department called structured finance, in a way to get as much money for little cost. And that meant there was lots of terms put in the loan agreements to protect the bank, because as you borrow more money, the banks are taking more risk because they're putting a bigger share in of the project, and they want to have more protections. So we're always looking at trying to explain to the client what that means, what those terms are, and there's a pricing benefit for all these terms.
And if it's at all helpful, we've talked about interest rates, how that impacts cost of debt and things like that. And we might talk about it a bit more in this one, but that was in the last episode. So let's talk about maturity of a loan.
So the maturity of a loan is when you have to pay it back, when the loan ends. But you often might find that you have a loan that amortizes at a different rate. So if you imagine a loan starts at the amount you draw down, maybe plus some costs, and it's spread payments and you gradually pay it off over, let's say, 15 years. So at the end of 15 years, the balance would be zero. But you might only have a 5-year maturity. So what that means is you're going to keep paying it off as if it was a 15-year loan. But at the end of 5 years, that's it, you've got to repay it. So there's a difference between what's called the amortizing profile of that loan, so it amortizes over 15 years, versus a 5-year loan.
Yeah. So probably helpful for people to be having this compared back to a mortgage, because a mortgage is the loan that most people understand because they often have to get it. Often if you're young, you can get, say, a 40-year amortizing profile, which happens to be the same as your maturity.
But you've bought a 5-year product or a 2-year product, which says that after 2 years, in mortgages, you tend to have the right to pay back, not the obligation. In a commercial loan, you might have the obligation to pay back in 2 years.
Often the case, actually. Yeah. Often having the obligation within 5 or 10 years max, really, unless it's some sort of corporate mortgage backed against property or something at the moment.
Yeah, so bank loans to the corporate world are nothing like as long as what you get for personal mortgages or buy-to-let mortgages. The principles are broadly the same. You have a period of time where you've got to repay that loan as it goes. And then at the end of it, you've got to make sure it's a zero. If that means you've got to pay off a lump sum, you've got to pay off a lump sum.
Absolutely. And I suppose with that framing, the next part, we've got a number of different types of loans here that businesses might use. We've just talked about mortgages. I think lots of people understand that. But a bullet loan, for example, that's an unusual term.
Yes. So you've got different types of loans do different things. And to the bank, it affects sometimes how they would weight that and therefore the internal cost of that money, which they pass on to you as a customer. A bullet loan is a loan that does not amortize, doesn't reduce, but it all has to be repaid on the last day, the maturity day.
Interest only, no capital repayment.
Absolutely. You've got amortizing loans, which means you're reducing the loan as we go, in different types of amortizing loan. Some reduce it as the fixed amount reduces every month, say a quarter, whatever you pay, how often you pay it. But the actual payments will vary because every quarter the balance is less. And you've got some that we don't have a sort of a curve, if you plot them on a graph, where the amount you pay is the same every month. So it starts off with a lot of interest and a little bit of capital. And by the end of the loan, the other way around.
A lot of capital.
Exactly. And then you've got other loans like revolvers, which say that you borrow and you've got to repay it normally every year for a certain number of days, then you can redraw it. So it's a bit like an overdraft, which everyone's familiar with. A revolver is a more formal loan with an obligation to repay within a period of time.
And the rationale for that is just to say, we don't need this money, but it's really helping us.
It's seasonality, typically. It's not your term loan is often a bullet loan, and that's to give you long-term capital at a low cost. So banks lending or lenders' money, it's not equity, it's long-term capital. A revolver should be used as a top-up. It's the short-term seasonality I have a quiet period in August and December. I need to borrow in those times, but have a really good March, so the loan will be paid off by March.
Yeah.
It's those sort of scenarios.
I sell umbrellas, so I need to buy stock just before it starts raining big in the UK, and then, which might be a way around, but let's pretend it's just seasonality. And then I can pay you back once I've got to the end of my busy season because I've got all my sales in. Another one we've got is accreting.
So accreting is a loan. The loan amount goes up every time, every period. And most loans you think of stay constant or reduce, but it's possible, particularly if you're a developer and you're building a property, there's little point in you borrowing money in order to just pay interest. So some lenders like that concept, but actually quite often you just say that you don't have to pay interest till this date.
Till you draw it down.
Well, until you've reached a certain point in time, maybe when you expect the project to have finished.
Oh, I see. So you're talking about a loan where the interest doesn't actually start accruing until a certain point.
The interest will accrue. No lender will give you, no lender in the normal market will not charge you interest. You just don't have to pay it. So the interest is charged, or accrued if you want to use the accountancy word, is because it's being added to the loan, but you don't have an obligation to pay it back until sometime in the future.
So you can just let the interest run and it kind of compounds and compounds and compounds.
So the interest is rolling up. Now, you don't tend to do that for very long.
It's quite an expensive way of having debt, to be fair.
Well, it's just the rate of the interest rate. Just the fact it compounds makes you feel as if it's higher, but it's still just a loan borrowing at that rate.
Yeah, but at some point you're paying interest on the interest, so that's the reason why it feels expensive.
It's expensive, yes. But you haven't had to pay anything as you go.
So next one's index linked.
So index linked, and you see this, the UK government's been a particularly big proponent of it, and it hits it in recent years. So there's an index, normally things like RPI, but doesn't have to be. So RPI being a measure of inflation, it says the loan balance will be increased by inflation every, let's call it 6 months. So whatever inflation was for the last 6 months, we're going to add that on to the loan balance, and interest will be calculated accordingly. The quoted rate on the bond, on these bonds or these loans, is much lower because to that interest rate is going to be added inflation. So these bonds will typically increase. They could decrease, but they typically increase because there's positive inflation pretty much all in most countries. They accrete. They grow up and they go up in terms of the outstanding nominal amount. And the UK government's used that an awful lot, which is fine when inflation is low, but when inflation went up recently, I think we're up around 10% a few years ago.
Starts to hurt.
It started to hurt. The payments that we were paying to the bond markets was quite high.
Yeah. Absolutely. So I don't have any more here, although I mentioned corporate mortgage, which essentially is the same as a mortgage just within a business. There's also, obviously, these are different profiles in terms of amortizing and various, and then how the interest is paid or just accrued and allowed to run and things. But we've also got a lot of different types of security that might be used against loans, and the banks sometimes sell products based on the security that's available. Actually, don't they?
That's how they market their products. So the usual one people talk about is a mortgage. So that's physical bricks and mortar.
Yeah.
This home, this office, this factory.
And that's a lender's favourite.
Favourite because the value is seen to be known. I mean, I get it. A valuer's opinion is subjective, but there's more data around it, more understanding.
Tends not to fluctuate much. Tends to go up.
The other one you can have is debtors. I've got my invoice discounting, so I've got my invoices that I'm due to pay. Well, there's a value to that.
Yeah.
The challenge for that is the lender doesn't know who you're lending to. So he knows maybe at a point in time. So what the lender will do is to say, well, I'm willing to back your business, but I don't know who's, and it's not a property, it's who's going to resettle these invoices. So I'm going to make an assessment on the invoices today, and I'm going to allow you to do it to anybody you like, such that they meet these criteria. So there are restrictions on who they will be willing to lend money against, who your customers are. And often there's what's called concentration risk. So you're only allowed to have a certain amount of debt with one individual client of yours.
So you can't have 90% of your trade debtors owed by one client, for example.
Yeah. Well, unless that client's a very big and wealthy client, yes.
AAA rated.
The bank, again, is working at its risk profile. What's it willing to to take as in terms of risk in order to get paid back.
And a bank would see trade debt typically as a lot less secure than property, so it'd be more expensive debt.
It's more debt is relies on systems. There's an issue around security as well. Because this debt might be settled and then you get another debt coming on, does their security apply? So you end up with a little bit of legal costs around what that security is, or quite often the bank structures the loan as it buys the invoice from you. The invoice receivable, the bank buys from you. So legally it says I can now pursue that debt under certain circumstances.
Looking at other assets, I mean, it's common for a bank to look at vehicles in a business.
So plant and machinery, vehicles are probably bigger market than some, but you do get plant and machinery. And these are sort of leases normally, much though the leases are often presented as a cash flow lend. What will this business be able to sustain from a cash flow perspective? Reality is the bank is also saying, what will I be able to sell these assets for?
Yeah, if you can't pay, I'll come and take those assets off you. Thank you very much.
Yeah. And the more specialist you have that equipment, the less it is likely to be worth from a lender's perspective. So vehicles are quite good because there is a active second-hand market. But if you were to do tanks, for example, there's probably not such a good second-hand market, or a specific bit of equipment that manufactured that widget.
Exactly right. And then another one, it would be stock. Probably one of the last ones would be stock.
Yep.
Again, depends how niche it is and how easily and readily you can sell it as to what sort of proportion.
The key thing from the bank's perspective, it wants to lend you at the cost of stock, not what you see as the value of stock. So the profit margin, it's not lending you your profit margin. You have to make a sale to get that profit.
Yeah, absolutely. Going on to the next term, which is probably a confusing one to see in a loan agreement, but it's margin. And this is not the interest rate they're charging. This is a proportion of the interest rate.
So depending on the type of loan, you have a base rate, for want of a better word. And in the US, it's normally 3-month prime, but it could be a bond, in which case it would be gilt rate or US Treasuries. So you've got a reference rate, SONIA and current loan agreements, LIBOR and old loan agreements, maybe gilt rate. And then on top of that, you have a margin. Then normally you're going to use LIBOR or SONIA, so a interbank rate rather than a gilt rate. We can talk about the reason why later, but you use an interbank rate and add a margin. That is the rate that you will pay for the borrowing that money. There are two aspects on top of that to think of. That's a floating rate. So in other words, it moves depending on what the underlying rate of the interbank rate, the SONIA rate is. The margin can sometimes vary depending on how long the loan is out for and how the risk profile according to the assets. But you've got a floating rate, and how do you manage that? Well, you could get a swap. You could go to a bank, normally usually the same bank, and say, can we pay you a fixed amount and you pay us that variable amount, which means I'm now just paying fixed because I don't have to worry. I've netted off. I've hedged that liability. And again, the banks would charge a swap margin. So you've got to look at all the components of what you're paying for. The bank cannot change the interbank rate. It's set by LIBOR. It used to be a bunch of people quoting rates. That was considered not to be so good. You can Google that and see why. But it's now got a different system, SONIA, but it's outside the realm of the bank as an individual bank.
We're going quite detailed now, but I think what would be helpful is to understand just basic level, difference between gross and net, and what is the interbank rate, how's it set, and how does that impact this? Because you see it written into a loan agreement very regularly.
Well, to be honest, I think it's less about how it's set by a bunch of banks. It's not really relevant for our business. Well, you could call it that, yeah. But what you're really seeing is if you're comparing two loans that are floating rate loans, and one says I've got a rate of 6 and one's got a rate of 7, your really question is, well, what was your assumption around the bank reference rate? Or are you saying it's a margin of ones have got margin difference of 0.5% or 1% or whatever? Most of the time you need to look at the margin to compare, or the various components of margin.
Yeah, because margin is normally added on top.
It will be added on top, yes.
And the gross interest will be the two combined. That's your real interest.
That's your cost of money.
That's your cost of money as a business, for example.
Yeah. And then you have something called a non-utilisation fee. So that's if you have a £10 million loan and you borrow 8 million, what about the other 2? Well, on the assumption you're able to draw that down if and when you need it, then the bank has got that sitting aside for you. The bank's got a cost of that money because it can't use it to lend normally. So it charges you a non-utilisation fee. It used to be called a commitment fee. So they've committed money to you, so you pay it. It's now a non-utilisation fee.
It's basically interest at a lower rate.
It's typically a percentage, 40, 60%, something in that region, off the margin. It's not charging you based on the total interest because you're not paying the SONIA rate. You don't need to pay the interbank rate because the bank hasn't borrowed that money. It just will when you need it. So you're looking normally at a percentage of the margin.
I think we've already talked about swap rate, fixed, floating, although I don't know if there's any more detail to go into on that.
I mean, I'm not sure there is. It's fairly straightforward. If you want to borrow, you're normally borrowing on a variable rate, and it depends on what the market does. It will reset every time you're paying, every month, every quarter, every 6 months, whatever. They will reset the SONIA rate, and that will be your rate that you've got to pay. But if you normally you might want to pay floating. Sorry, you might want to pay fixed. In which case, you've got to look at the bank that you're borrowing from. Where does the bank get its money from? So if you're looking at Barclays Bank will get its money from its deposits. So it's generally going to want to give you a floating rate. If you want a fixed rate, Barclays will delightfully offer you a fixed rate, but it will embed into that something from its treasury department, which will be a swap. Now, either at the higher end of when you're looking for big loans, they'll separate the two out to allow you to manage your treasury function. But at the lower end, they'll embed it into an overall rate. But behind the scenes, the corporate bank department will have agreed some sort of borrowings, which gets embedded into the deal with you.
Well, we've already talked about non-utilisation fees, which are on the list, but then there's also commitment fees.
That's the same thing. It's the same thing. It's just a modern word for commitment.
Okay. Well, let's move on to arrangement fees then.
So when you borrow money from the bank will spend its time with you. They might even buy you a coffee. But I think that's probably all it's going to do. You are then going to be paying all its costs. They also will take an arrangement fee. So that is the cost of them bothering to give you the money. It's not the cost of the lawyers and all the other advisors that they're going to have on that team, the valuer if it's a mortgage. You'll pay an arrangement fee. Now, in large syndicated loans, the arrangement fee is kept separate from the main loan agreement. So all the other parts of that syndicate will get their share of the loan, but not their share of the arrangement fee. So the arrangement fee is separate. In bilateral loans, that's when there's one borrower, one lender, the arrangement fee is often put in the loan.
Yeah. It's straightforward. For a syndicate, I'm not sure everyone will understand what that is.
So that's when you might have 3 or 4 banks lending to you.
That's often for a mega deal.
Well, much bigger deals, yeah.
Where, it's almost too much risk for one bank to take.
That's exactly it. So you're borrowing 100 million, you might have 4 banks at roughly 25 million each. One party's been doing all the work. It wants to get a better return. And others to justify all that extra work. So it keeps a larger share of the arrangement fee, if not all the arrangement fee.
Next one, the terms obligor and guarantor.
So most people understand what the guarantee is. I've guaranteed that loan. So that could be you as an individual, as a director or shareholder, could be you as another corporate within a group, could be you just a separate organisation. For whatever reason, you've agreed to guarantee that loan.
And people have probably come across it because they might have had family members guarantee their mortgage when they were starting out.
Yes, exactly. It's, it does exactly what it says it is. I guarantee to make those payments as they fall due. And normally it's only going to get called when the borrower hasn't paid. So when it says pay those payments when it falls due, it normally means everything because the loan has just accelerated, gone into default, and everything has to be paid off. The obligor definition is saying, look, I'm effectively willing to be bound by all the terms of the loan. So somewhere in that corporate chain of group of companies, there's one borrower, and I'm relevant to that lender, not just as a guarantor, but everything I do. So I agree that I'm going to sign up to the same terms. I'm going to be an obligor and I will sign up. So normally it's if you've got a business that buys other businesses. So you've got one lender to come in and said, look, anytime you add somebody to the group, they must become an obligor. And then there's a clause that says all obligors must have a debenture. So now you buy another company, you've now got period of time, say 30 days, whatever the clause, the contract says, to get a debenture in place for this entity you've just acquired.
Seeing as you've just mentioned it, and I don't think we talked about that particular type of security, let's talk about debentures. What the hell is it?
Okay, so mortgage is a fixed security on an asset. So if it goes to insolvency, the bank will have first right on getting repaid from that security.
Yes, we've talked about property. We've talked about, plant and machinery and stock.
Whatever's a first charge, it gets first, right?
Yeah.
You then got something called a floating charge, a debenture that says, I just want to rank ahead of people that are ordinary creditors.
And where would the debenture, what would it be
A
against?
debenture would be,
It's
it's against all your assets that are not fixed charged. Or
typically in a company, right?
in a company, yeah. Well, yes, it would be a company. And it could be first charged assets, but only to the extent that it's not covered by a loan. So what's left after repaying the first charge holder.
And this is something you'll often see on Companies House, actually, won't you?
Debentures, yeah. So mortgages would be covered under that rule as well.
There's a charge.
Yeah, so you normally have a mortgage will often be a debenture as well. But a mortgage, you're effectively saying it's a floating charge.
That's helpful.
And then you've got to think about, the government changes the rules very depending what it wants. Where does HMRC sit in that list? Is it a preferred creditor, isn't it? Mm-hmm. And that's matter for the future. You can't change that.
Moving on to CPS, condition
precedents. So you get a loan. In that loan, there will be conditions that you must meet before they'll give you the money. So I must, if I'm going to buy a business, I will sign and borrow the money to pay it. One of the conditions, I've signed the loan, they're not going to give me the money now. I'm then going to say, well, I've got to have a loan agreement. I've got to have done due diligence on it. I've got to have profits over a certain level. I've got to have my accounts audited. Got to have a valuation of the property. That's a condition precedent. It's a condition required before I can draw down on that loan. Bank will happily sign you the loan. You're then got incurred arrangement fees you'll have to pay probably unless it's on drawdown. So you can sign them, doesn't mean you've got any money. Condition subsequent is normally when they say, well, you've now got this obligation, but you don't have to do it now. You just got to get it done by a certain date. So you need to get a debenture put in place. Well, that would be a condition something. You might say within 30 days of buying the business, you've got to get a debenture put in place.
Yeah. Next term is waivers.
So waivers are when you've got an obligation and you're asking, like, I can't really meet this. Can you let me off this condition, this obligation? I've got to provide my accounts within 30 days. Can I just do them once annually? And yeah, if you don't do it, you could be in default. You take the risk that the lender will say, for whatever reason, not necessarily related to this issue, I'm now calling in your loan. I'm calling you in default with all the obligations and issues that will have. So you ask for a waiver. So it's important as a borrower, you know all your CPs, condition precedents, and you make sure you can meet them. You know all your condition subsequents because you need to meet them as well. And to the extent you've got a problem with them, can I get a waiver? Now, you're unlikely to get a waiver for you're not likely to get a waiver for major issues. You shouldn't be asking for them if you haven't signed your loan agreement. That's only when disaster strikes you. You see if you can get some help. Waivers are normally for minor infringements and minor things you're going to struggle with. I can't quite get these accounts done in 30 days, and I get them in 35 days. And the lender goes, yeah, fine, I don't want to go and cause default, send the loan off into my workout team and all the issues that's caused. Yeah, that's fine.
Timing, you mentioning defaults and default events, because that's next on the list.
So there's a difference between event of default and default. So default is when the bank has said, I am now not happy. I'm now effectively going to try and take control. I'm going to accelerate the loan. I'm going to appoint all my advisors and you're going to pay further. I'm going to do all sorts of things. And a defensive default has said you don't meet the obligations that you're meant to. So you might have a loan covenant that says, look, my profit figure, my EBITDA, depending on how it's defined, but let's say my EBITDA has to be for this loan £100 and you've only got £99. So actually you are in an event of default. The loan agreement says that's an event of default, but you're only £1 down. So you go to the bank and say, look, is it okay? Now, you ask for a waiver to say, please let me off this time, and the bank will give you a waiver. They may say, I'm not willing to give you a waiver, but we're not going to call default yet. And that's because you're in an event of default, but they don't want to accelerate the loan and call a default. So you have event of default is the trigger, but the trigger is not necessarily, it's not
the be all
pooled, it's not be on until it's called into default. The things you need to look out for in events of default are forward-looking issues. So potential events of default. Material adverse change. Well, who decides if something got an adverse change in material? Normally the bank will decide.
Yeah. Next one is prepayment and acceleration.
So there's a difference between prepayment. Acceleration is when the bank has said, this loan now needs to be repaid. You're past maturity, you're in default, whatever these is, they've said under the legal loan agreement, they've got the right to demand repayment. Okay, now one hopes you've got a good dialogue with your lender before that happens so that you can manage that situation, presumably with some cash you've got on the side or a new lender lined up, but that's what you've got to deal with. Repayment is when you say, I want to do it in advance, I'm going to pay your back loan early. And that has a couple of issues. One, you've got to think through, is there a cost to that? The bank is planning to receive this money over, say, 5 years, and you're only going to give them 2 years' money. Will they want to get paid a premium? Sometimes they charge a price, an early redemption charge or a prepayment fee for paying their money off early.
A bit like when you come out of a fixed term with your mortgage.
Yes, you've got a fixed term in your mortgage and you want to pay it early. There's often a clause. Now, mortgages, domestic residential mortgages normally allow you 10%. But if you wanted to pay more than that, then you end up with what's called an ERC, early redemption charge, and that is like a prepayment penalty.
Yeah, exactly. There's a few that give you 20%, but it's mostly 10, isn't it?
Yeah.
And one that's come to mind is warrants, and I think that's an interesting one.
So warrants are not the norm in large banks or the high street banks, but is in the sort of private credit market, and really it's a yield enhancement. They are lending money to allow your business to grow. They feel they're taking a degree of risk to give you that opportunity. They say, well, we want to slice the upside.
Yeah.
We're taking all the downside. We want to slice the upside. And a warrant allows them to buy into the equity of your business at a set price. Sometimes you can negotiate, so it's not a price for equity. It's a payment of a fee equivalent to the value of the equity, and you can negotiate that definition. But it's a yield enhancement.
I think another yield enhancement, whilst you've mentioned that, is an equity kicker. And without wanting to take away from the next bit, we've spoken to lots of different lenders on behalf of clients, and obviously we've got high street bank, often the cheapest, usually have the cheapest sort of money that they are accessing. You might then go to private equity or second tier lenders after that, and
So
what is
I
an
think-
equity kicker?
I think when you borrow money, it's important to understand where they get their money from. So if you've got somebody who has got the money from a bank, in other words, a high street bank, where do they get their money? They get their money really cheaply. It's deposit holders, it's money markets. About the cheapest you can commercially get money at. If you go to private credit providers, and there's a market for private credit without a doubt, and where do they get their money from? Well, if they're got another arm to their business, which is private equity, chances are the people that are doing the relationship building with investors are the same people. So you've asked somebody to give money to this private equity fund, and then the next day you ask them to give money to private credit fund. That individual is likely to, or that organising, that investor is likely to want the same sort of return. There'll be some risk adjusting, and of course it's not going to necessarily be quite the same because there's a difference between equity and debt, but you're not likely to get the same rates as a high street bank. By understanding where the source of the lender's money is, tells you where you should be expecting to get the cost of funds for you. And where it's looking at private equity driven, it's dressed up as debt, equity kickers, whether that's through warrants or another means, are likely to be quite common because those lenders are tapping into money which is used to lending money for private equity.
And getting returns of 20% per annum. Right, I think that covers off all the debt terms. Thanks for joining on this episode. And next time we're going to be talking about equity instruments and all the terminology around that. And hopefully that'll be helpful to you and your business. Tune in for next time.